We are a little under a week away from the Fed's September meeting, and interest rate traders largely believe the Fed will hold rates steady this month. The central bank has been digesting a number of economic reports that point to some slowing growth, but inflation remains above target levels. And the U.S. is facing a number of issues that could leave a mark. EY chief economist Greg Dackel joined our program yesterday, naming the triple threat facing GDP growth: the resumption of student loan repayments starting in October, a looming government shutdown, and the UAW officially on strike. Here with more on the economy and risk to markets is Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. All right, so thank you so much for joining us this morning, Victoria. So let's get your view on these risks, these headwinds. Do you see these as the headwinds that we should be really paying attention? These student loan repayments, the strikes, are those the risks that you are kind of bracing for?
They're definite headwinds, Diane. I think we have to watch these elements that are there. Obviously, when you look at the strikes that are going on, that is the whole question of labor cost for corporations. How much higher is labor cost going to go, and what does that mean to margins? And then that flows through to earnings. So definitely a headwind. Student loan repayments, again, the strongest story of this economy for the past 2.5, 3 years has been the strength of the consumer. And so if that's taking a hit from student loan payments, then obviously that's going to be something we need to watch. You also need to look at oil prices. We are at 10-month highs right now. That feeds through to a lot of other elements. A lot of people think, okay, yes, that's going to hit the consumer in their pocket for filling up their cars with gas, but we have to remember transportation cost and input cost into all sorts of elements, into our groceries, into commodities, into everything that we do. Those prices are going to go up as well. That feeds into inflation. And so if inflation continues to be sticky, then that's obviously going to be something that the Federal Reserve is going to have to continue to fight. So yes, these are all headwinds combined with other elements. I think housing is something we have to watch too. Housing prices continue to go higher because supply is so low. Everyone thinks rent is going to come down and that sticky component of core CPI will go away. But if housing prices are moving higher, we could see some resistance there as well.
So, Victoria, putting this all together, the S&P 500 is down about 1.8% since its most recent high. Does that reflect the concerns? Does that adequately reflect the concerns that you're talking about?
I don't think it does, Julie. And it's an interesting fact. If you look over the last week and a half or so, I really think the market has kind of changed the way that they're looking at some of these economic reports that we're getting. A couple weeks ago, 3 weeks ago, we were in that good news is bad news environment. Anything that came out that said the economy was strong, the market and investors looked at that as, that means the Fed is going to continue to hike rates. We've had a shift as of late, and it looks like the market now is looking at good news as actual good news for the economy. I think that means they believe the Fed, if they're not done hiking rates, they're pretty close, right? Maybe we get one more hike later this year in November, and then they think the Fed might be done. And so they're starting to shift the way they interpret this data. That might be one of the reasons that even in a week when inflation is higher than expected, the labor market is stronger than what people anticipate, and we're even seeing rate cuts get priced out of the market that had previously been priced in. You still have, all in all, a pretty decent equity market this week.